Switzer.
Welcome back to Switzer on Sky News Money. After 10 updates in a row, the local market pulled back 13 points a day. What's next for Australian shares? Are we going to see 6,000 soon? Joining me to discuss this is Medallion's Financial Managing Director, Michael Wayne. Michael, thanks for joining us on Switzer.
Thanks for having me, Paul.
Let's start with that question everyone's got, 6,000. Are we going to see that soon?
Look, I sure hope so. It's proved to be a very strong point of resistance a number of times going back to sort of 2013. October's historically been a very strong month for the ASX. The banks, for instance, rise on 80% of occasions. There's a lot of cash coming in for dividends that investors and large institutional investors redeploy in the market. So October's been true to form this year. But as we draw to the back end of October, there are a number of different events that are coming up onto the horizon. We've got the third quarter, or the quarterly earnings season in the US, really ramping up this week with the vast majority of companies reporting their quarterly earnings. Here in Australia, we've got the AGM season really ramping up this week, and this has turned into a bit of a de facto quarterly earnings season here in Australia. So look, I think we probably can breach that 6,000 points, but there's still a little bit of water to go under the bridge until we see that occur.
Let's go to a couple of things that are coming up in the market. I want to come to the banks first because both, or at least ANZ announced that it had reached potentially a settlement with ASIC over the BBSW, the bank bill swap rate allegations of market rigging perhaps, and rumours that NAB might also be about to do a settlement. We start with sort of the bank's earnings season coming up. ANZ kicks off on Thursday.
Yeah, that's right. So we've got the bank reporting season where three of the big four, so ANZ, NAB and Westpac, are reporting their earnings over the next couple of weeks or so. You can throw in Macquarie as well. They're reporting their half-yearly results on Friday, and they're obviously a huge constituent when it comes to the ASX. So if they can come out with some positive results, the market can certainly continue to push higher. My belief is that these set of results for the banks will be the best in a couple of halves at least. I think net interest margins will at least plateau, if not move higher somewhat. The last sort of couple of halves or so, we have seen funding costs really come down significantly, and we've seen less competition as well in the deposit markets. So hopefully that flows through to banks. It'll be interesting to see those net interest margins, whether in fact they can actually move higher. We did see that Bank of Queensland just the other day delivered some improved net interest margins. So I think that will be a key catalyst, which will determine whether this market can push up not only the 6,000 but beyond that point.
And so, Michael, are you seeing the banks in sort of a buy zone territory?
Oh, look, I wouldn't say that. They're more of a hold, I think, leading into this reporting season. I'm pretty agnostic on the banks, to be honest. Looking out sort of 3 to 5 years, I do think it's going to be very difficult for these banks to continue to grow earnings at the same rate that they have over the last 20 or 30 years. As mentioned many times in the past, we've seen interest rates come down from double-digit territory to record lows. The fact is that fueled a big explosion in credit. Housing prices went through the roof, and it was almost a perfect storm for bank profitability. Going forward, I think it's less certain as to where earnings will be heading for the banks, and for that reason, I think the majority of your earnings, or the majority of your return when it comes to your investment in the banks, comes from the yield component. So I think banks primarily will just trade on fluctuations in sentiment. We saw Commonwealth Bank get down towards the bottom end of its trading range, around that $70 mark. At those levels, the yields and the grossed up yields look quite attractive, and you see money start to flow in. So I think that's the way you've got to trade the banks going forward, is more in a range as opposed to having a long-term convicted position as to where earnings are heading.
Now, today we saw some of the interest rate defensive stocks and sectors just come under a little bit of pressure as US bond rates climbed and our local bonds followed. So things like Property Trust, maybe Sydney Airport, some of the utilities came under a bit of pressure. Is that a trend you expect to continue, or a bit like last November, December, if they get sold off too far, is it going to be another buying opportunity?
Look, it is difficult to say. Many people have been burnt many times calling the sort of bottom and the turn in the bond markets and the yield markets. We have seen the US Treasuries move higher. The probability of an interest rate decision by the Fed in December of being another move higher and was up around sort of 80–85%. So I think, look, it's getting less and less likely that we'll see the lows in, say, the 10-year Treasury tested again. So for those interest rate sensitive stocks, those yield proxies such as the real estate investment trusts, the utilities, you mentioned Sydney Airport's Transurban, that was under a bit of pressure today. If we continue to see bond yields move higher, not only here in Australia but also in the US and around the world, then you can expect that pressure to continue. So I would be cautious of those sectors in this current environment, because at the moment we've got uniform global growth, we've got Europe, China really recovering quite well after a couple of weaker months. US managed to get through the hurricane season pretty well unscathed. So that synchronised global growth that we really haven't had since 2011, I think means that bond yields could continue to push higher.
Okay, so look, it sounds like you're a little neutral on banks, a bit negative on some of the interest rate defensive stocks. So the obvious question, Michael, what's going to push us to 6,000 and what sectors do you like?
Yeah, look, it's become a bit tougher, that question. If you asked me a couple of weeks ago, I would have said things like the IT space, for instance, the healthcare space as well. But I think going forward, diversified financials still remain attractive. We've seen companies like Platinum Asset Management really come back and then turn around significantly. I think companies like Janus Henderson Group continue to offer value. That's an old spin-off from AMP going back a number of years. They've recently merged with a company in the United States. It's called Janus Group, and that will give them a nice distribution platform into the US. I think Challenger continues to be a buy, even despite the big run-up that it's had in recent years. That's a stock that's very much aligned to the ageing population, the big boom that we're seeing in superannuation. But not only that, I think the ageing population factor means that people are looking for income, consistency in yield, and annuity products are one of the fastest growing products in financial services. So after a very good update the other day, I think sort of Challenger you can keep on your list, as well as something like a Janus Henderson.
So it sounds like you're looking for stocks with sort of tailwinds. I just want to turn to some of the stocks that are most shorted at the moment, just to get your reaction to these four well-known stocks: Domino's, JB Hi-Fi, Healthscope and Retail Food Group. Any contrarian play there yet, or of the shorters, are they going to be right?
Oh, look, I think they've been pretty spot on. I mean, Domino's Pizza was one I liked going back a couple of years, and it's a very high-quality business, but I think it got up to trading on about 60 or 70 times earnings. Their growth rates, although they're still growing, they're growing at a decreasing rate. So I think it's only fair that they've come back to the field a little bit. Their expansion in Europe is really going to be the key driver for this business, whether they can get margins in Europe up to the same levels that they've had here in Australia. And I think it's going to be a bit more difficult than the market was initially anticipating. The pick of the bunch for me out of that group is probably a Healthscope. I know this one's a bit of a contrarian play. People have always preferred the likes of Ramsay Health Care, and I like Ramsay, but I think on a valuation basis, Healthscope's also attractive. It's not necessarily one that's going to jump up in the next 3 months or even year or so, but once these projects that they're sort of building at the moment come to fruition, I think there's a lot of capacity that could really come into that sort of business. There are obviously risks associated with their big expansion project, but I think if they pull it off, it's a company that very much is aligned to the ageing population. Being involved in that private hospital space is certainly one to keep an eye on, considering it was trading around $3, has been as low as $1.60, $1.70. It's formed a bit of a base and moved higher. There's been some favourable commentary coming out from the likes of Macquarie recently as well, so I think that's one to certainly keep an eye on.
Okay, well, write that one down, Michael, and also I think the advice you're saying is look for stocks that have got tailwinds rather than headwinds. So Michael Wayne, the Managing Director of Medallion Financial, thanks for joining us on Switzer.
Thanks for having me, Paul. Coming
up, we'll look at cryptocurrencies and in particular the spectacular rise of Bitcoin with David Bassanese, the head of chief economist at BetaShares.